Imagine you're the one people rely on to make sure a company's financial story is true. Not perfect, just true enough that people can trust it. Because here's the secret. In accounting, not every mistake is equal. Some errors are just background noise. Others can change the entire decision someone makes. That's where materiality comes in. Materiality is our way of separating what matters from what doesn't. Think of it like tuning a radio. There's always static in the background, but you're listening for the signal, the part that actually shapes your understanding. In practice, auditors often begin with a benchmark, such as a percentage of profit, revenue, or assets to develop a preliminary materiality threshold. But that figure is only a starting point, because materiality also depends on context and professional judgment. Maybe 5% of net income, maybe 1% of total assets. These aren't magic numbers, they're guideposts. So if a company earns $2 million, 5% is $100,000. That becomes our threshold. Cross that line, and the error might influence someone's decision. But here's where it gets interesting. Materiality isn't just about size, it's about context. Picture this. A company has a loan agreement with strict conditions. A tiny error, maybe just a few $1,000s, pushes a ratio out of compliance. Suddenly, that small mistake becomes huge. It could trigger penalties, raise interest rates, or even threaten the company's survival. So materiality isn't just a number, it's a judgment. It's understanding what's at stake. Now let's add another layer. Performance materiality, or audit planning amount. If our overall materiality is $100,000, we don't wait for an error that big to show up. We set a lower threshold, maybe $70,000, as a safety net. Why? Because errors add up. A few small misstatements scattered across different accounts can combine into something big. Performance materiality helps us catch issues early, before they snowball into something that misleads the people who depend on these numbers. Let me paint a picture. Imagine you're reviewing a company's expenses and you find a small misclassification, nothing dramatic. But you follow the thread, and it leads you to a pattern that, if left unchecked, would have pushed the financials past that $100,000 threshold. You caught it early because your performance materiality was set thoughtfully. That's the power of these concepts. They're not just rules, they're tools that help us protect trust. At the end of the day, materiality and performance materiality help us focus on what truly matters. They keep us from drowning in details while making sure nothing important slips through the cracks. Because when people can trust the numbers, they can make better decisions. And when decisions are better, businesses are stronger, communities are safer, and the entire financial system becomes just a little more reliable. That's the real impact of materiality, not just in the numbers, but in the confidence it creates. Thank you for watching. Stay tuned for more bite-sized lessons in accounting and auditing.